All right. Well, last time it was all about FTDs and naked shorts, and you guys wanted to hear more. So we are back with more. The word of the day today is rehypothecation. What is rehypothecation?
Well, rehypothecation, the phrase, so just to set the stage here, the world of securities finance is a world of collateralized lending. So these aren't credit cards, these aren't other types of loans that people just give you money in exchange for a promise to repay because they think that your credit score is good enough. This is a world where collateral matters and collateral quality matters. So rehypothecation and basic hypothecation is, first of all, connected with how you get money. And a way to save, a lot, and this actually goes back, if you ever even read Jesse Livermore, I have Jesse Livermore's book on my shelf here, Memories of a Stock Operator, Memoirs of a Stock Operator.
Is even better, actually.
Is it? I'll have to get the new edition of that. Yeah. But they talk about trading on margin, which is basically trading on capital from the exchange. They called it the money post in those days. Jesse, you'd go to the money post and the money men would front you the capital you needed to trade. But hypothecation refers to the idea that you post collateral and you get cash for that. So say you want to buy securities, you want to buy something else. If you already have stock in an account, you can post that stock as collateral for a loan. Typically in any margin agreement with any margin account, most of us have margin accounts, you sign an agreement up front, a rehypothecation agreement. So in a typical example, I'm an account holder, whether I'm a retail investor or even a hedge fund, I have these securities in an account. If I want to borrow against those securities, I sign this rehypothecation agreement. My broker, typically a bank, will give me cash based upon the notional value of those securities that I posted as collateral. That's hypothecation. Rehypothecation is when that broker dealer or that bank take those securities and do something with them. They rehypothecate them. They can use those as collateral, their own collateral. They basically recycle that collateral to get access to capital somewhere else. Or I think more commonly, they lend them out. They lend them to other clients for the purpose of short selling. So in this process, if you think of this daisy chain, account holder A has deposited securities in margin account A. Those securities have been used as the foundation for a loan to A, but then those securities are then lent by your broker to somebody else, person B, for the purpose of a short sale, and then sold on to a new beneficial owner. And that process, you can imagine, can be repeated to a certain extent and create more beneficial owners just upon the one beneficial owner. There's also the theory that sometimes brokers use the original pot of securities for the purpose of locates and lending multiple times to multiple different hedge fund clients, so those are two different ways of imagining how you can have multiple short sales based upon one original pot of securities.
And do you think it could be all of the above, right? So they're using it for locates. They're also lending it, that those lent securities are sold to someone else, and then their broker takes them,
right,
and does it all over again. And this
yes.
is what you've called chain lending.
Chain lending, yeah. Absolutely right, Dave. I think it can happen. All of the above can happen. And the Wall Street defense of these practices, to the extent they are a defense, is most securities are easy to borrow. So it doesn't matter. We have a reasonable belief that we can locate securities prior to settlement. Therefore, we're covered legally, and we don't have to. Our compliance department doesn't have to worry about whether these are bona fide locates, because the vast majority of securities are easy to borrow, and that's probably a true statement. The problem is the 5% that aren't, where you get lots of crazy stuff happening.
Do you think there's a limit to the number of times like one share can be used in this way?
The only limit, in economics is the dismal science, because economics is the language of constraints. So economics, we talk about goods are, by definition, goods are scarce. There is a supply curve, and the scarcity of goods imbues them with value. Our securities markets, on the other hand, are built upon the notion that whatever the paper number of shares outstanding is, the denominator on paper, that determines the value of the security. And any trading that happens subsequently is irrelevant. Mm-hmm. So it doesn't matter. I guess the answer to your question is theoretically no, and theoretically the regulators don't care, because the efficient market hypothesis tells them it doesn't matter. The same pot of securities can be lent, but that doesn't affect the denominator in the math equation. The market's going to discover the fair price of the asset anyway, regardless of how much trading happens on a daily basis. That's their defense. I don't necessarily believe that, but that's the defense that they must.
It's such a silly defense, right? Because like the market value, the price discovery mechanism is based on supply and demand.
Absolutely, absolutely, and it also assumes that there's no feedback. As Soros, the most famous, one of the most famous traders in history, would say, markets are reflexive. They're feedback effects. Right. He built his entire career as a trader on the reflexivity of markets. There is certainly a reflexive effect. If you can just push the price around in the short term, that has a feedback effect upon the demand function for these assets, and that's certainly what happened in the case of a lot of these threshold securities.
Yeah, we've actually pointed out to regulators in the past that often, especially in the rule proposals, they fail to account for reflexivity in markets.
Oh yeah,
right.
You should cite Soros's book. That would be.
I guess so. Yeah.
Well, by that logic, why would we not just allow counterfeit money to circulate? I mean, wouldn't that logic apply the same to the dollar? We've only issued so many dollars. That logic doesn't apply anywhere else. So why does it apply here?
Well, that's a very interesting. By the way, I'm saying this to you now because I was at a meeting at the SEC across the table from their chief economist, who pulled me out of after the meeting. We had gone into the meeting to say there's all this naked short selling happening. There are hundreds of companies on the threshold list. They've been on for hundreds of days. And he pulled me aside afterward and said to me, naked short selling doesn't matter. It doesn't matter how much trading happens in these securities, as long as the number of shares, the denominator doesn't change, shares issued and outstanding, the market price is fair.
What a crazy thing. I mean, like, what does it matter that the shares outstanding hasn't changed if the shares that are trading are
no, it is a bizarre argument in that, but this is where ideology and perhaps I honestly don't know if he really believed it. Maybe at the time he really did believe it. He since left the SEC and went into private practice, representing the firms that he was regulating as an economist in private practice. So I don't know if he really believed it or not. I think what the SEC honestly believes is that, first of all, these are corner cases. As I said to you all last time, I was at a meeting at the SEC with a very senior person who said we don't regulate for the corner cases. Right. They really believe these are corner cases. They also, and this is also true, they believe that there aren't enough short sellers helping them uncover frauds in the market. They sort of see these short sellers as bounty hunters, assisting them. A lot of this is the thought that came after the Enron, Jim Chanos days. Chanos was hailed as a hero. Yeah. He and Bethany McLean for having broken the Enron story. And so the SEC thought that they were simply outmatched and they needed short sellers out there uncovering all the frauds that are happening, like Netflix and Chipotle. Oh my God, these terrible frauds. They should be on the threshold list for hundreds of days. These terrible companies that nobody uses today.
Yeah, John sent over some data before this, and we'll maybe if we've got it handy, we'll throw some of this data up. But you looked at historical threshold list appearances and Absolutely. How many days some stocks have been on threshold, and maybe I should say how many years some stocks have been on the threshold list. And we talked last time about what that means, that there were, generally speaking, the failures to deliver were over the threshold, something like 0.5% of the float. Is that right?
Right. So to qualify for this threshold list, you have to have fails not over 0.5% of the float, but then they also have to persist for 5 days at the clearing corporation. So that's the key thing. So if you're on there for 3 days and you come off, you'll never appear in the threshold list. You have to stay there for 5 days, and then you go on this list of stores.
And some of these companies are, like you said, Netflix was on there for almost 2 years.
Absolutely. Netflix,
Krispy Kreme,
Chipotle,
some of the most delicious fast food out there.
Krispy Kreme was on for 640 days. Lazy Boy, 586. Chipotle, 544 days.
I don't know about you. I love sitting in a recliner eating donuts.
There you
What
are.
are short sellers doing attacking these companies?
Right. I assure you they do
America.
too.
This is terrorism.
They're attacking America. Well, the interesting thing about the threshold list is they don't make it easy to get the data. So they post it. I think we talked last time about how the fails data, technically those are owned by DTCC. And so the SEC argued that they had difficulty providing this to us. So they had to get special permission, and now we're lucky to have the fails data. Well, the threshold list data is the exchange data. So and I should say it's the listing exchange data. So not the trading exchange, it's the listing exchange. Mm-hmm. And there are technically 5 that are post this. The big ones to focus on are NYSE and NASDAQ. But the NASDAQ data, to get the NYSE data, you have to write a special script to web scrape because they don't allow you to bulk download it. The NASDAQ data you can at least bulk download, but the NYSE data you can't. You have to write special script in Python or some language to be able to scrape all these text files. And even then, they have memory hold the files pre-2007 and before. So it was fortunate that I have those in my records to get the 2007 files. But they make it very, very hard to get these historical lists from.
Yeah, and we just talked about the companies, the ETFs. It's just insane. I mean, it's honestly staggering. Years and years of threshold list appearances.
And of course, XRT is the big winner there. And XRT, almost 1,700 days on the threshold list. As we discussed last time, I do believe that this is related to some kind of swap or synthetic lending. You know, the idea is that you can't get short. Some ticker in there is hard to borrow in the XRT, the S&P Retail 100. So you short the ETF, but somehow you have a long position on the basket of the other 99 stocks. So you're synthetically short that one ticker through this creation of this product. I'm convinced that's what's going on here. Otherwise, why would it happen? What's especially weird is that the SEC is so silent about ETFs on the threshold list. It was
agreed.
If you go back in time, this period of 05 to 08, which was the pregnant moment for a lot of this change, there were lots of people yelling about all the hundreds of tickers on the threshold list. But now the SEC has just been very, very silent since 2009. They have no interest in resolving this matter, sadly.
It's interesting that there's a really fundamental difference on the charts that you've put together between NYSE and NASDAQ post Great Financial Crisis. That you see a far lower level of activity of threshold counts on NASDAQ post 2009, whereas NYSE, maybe since 2017. On average, it's been a little lower, but it looks very noisy to me, and it looks like it's stayed pretty similar, in the same general range.
No, I agree with that. You see that very, very steep drop in the NASDAQ, because that was where all you had the growth companies. This was the post.com shakeout that happened, and it went down to this slow burn in the 20 to 30 tickers per day. Whereas you're absolutely right, NYSE has been more volatile, higher ranging over that same period, not as dramatic a change. I can't account for this. I think one of the, I benefit now in hindsight because I had worked so closely with the Overstock people who were very active in this area. But, and I mean this very sincerely, if they hadn't done what they did, and particularly Jonathan Johnson, who was the general counsel, that I work with very closely, I'm not sure a lot of progress would have been made on these issues. And ever since the Overstock case resolved, there has not been a company out there that is vocal, an issuer, being direct, being vocal, communicating directly with the SEC. I think that's what was novel about the process. And I really think that it's fair to say the Overstock people deserve credit for a lot of the change that occurred in this area, particularly in eliminating the market maker exception when it was so obvious that it was being abused.
So yeah, I do want to talk about Overstock in a bit. I want to ask you a couple questions though, sticking
Sure.
with rehypothecation for a minute. We got one question. What role do you think direct registration could play in affecting the amount of rehypothecation, if any? You know, for example, like GameStop, something like a quarter of the float has been directly registered. Does that have an impact on brokers' ability to rehypothecate and chain lend, or is it doesn't matter because they can just take a small amount of shares and turn it into, you know, this crazy chain?
Right. You know, the short answer is I don't know. I will tell, if you mind, can I give a little bit of history about how we got here?
Sure.
So, and I know I mentioned last week the last time we talked, the paper crisis in the 1960s.
And I did want to ask that about that. As a quick aside, did you see that Tennessee hearing about the Universal Commercial Code changes they were going to make?
Oh no, tell me about that.
Okay, all right. So let's go on a tangent for a second, because we did an episode of this last week where Tennessee made some changes to their laws around exceptions for bankruptcy priority. So what they have is, if you have a margin account or you've lent your securities out and the broker declares bankruptcy, the creditors have priority in a bankruptcy over you, the owner of those entitlements. And they changed that in Tennessee to say, no, the investor has priority in a bankruptcy over creditors. And David Webb, I think, was pushing for it, and he testified to start that hearing. And he talked about the paperwork crisis and the idea that, well, one, he said it was actually, maybe I saw this in a different one of his videos, but he said that it was actually the CIA, someone from the CIA, that founded the DTCC. And he had just barely been separated from the CIA. But he also made this point that that actually the paperwork crisis, where I had your slide up on this because it was so good, that the paperwork crisis from 1967 was something where they had to close the exchange every Wednesday for 6 months, I think. And then he said, but then it was over. Like, they actually got past it, but that didn't stop them from creating the DTCC, and then many years later using the paperwork crisis as justification for dematerialization, where it really wasn't a compelling reason. It was just something they could point to, but it was over at that point.
Yeah, never let a good crisis go to waste.
Yeah, right.
That's fascinating. I'll please send that to me. I'm a fan of David Webb, and he's having a moment right now.
Yeah.
That doesn't surprise me. I think. Well, let's talk about whatever the truth is about what the situation in the markets was. I do know this about Wall Street. Wall Street is a reactive set of institutions. So they are not innovative. They're not proactive. They are a reactive set of organizations. They benefit from very generous set of rules around them that raise barriers to entry. So they're almost never forced to be better about anything. They have to just be marginally better than the person across the street. But the set of institutions, somehow in the early 70s, whatever the case was with the paperwork crisis, it was agreed that the solution was immobilization and dematerialization. So those are the two words, those are the two key concepts that we live with today. We are the children, We're the grandchildren of immobilization and dematerialization. And they define every problem that we have in market plumbing today was these two, call it the original sin of the early 1970s. And when they created the Central Certificate Service in 68 and the Depository Trust Company in 73, the result of this is that all of this stock, the idea was, okay, we're going to take rather than moving the paper around in hand carts, they would have these stock jobbers moving it around in hand carts, and we're not going to do that anymore. We're going to just put all this paper in a building, and then somebody's going to have a registry of who the shareholders are, and then somebody else is going to be in charge of changing names in the registry, and that's going to be the transfer agent. Mm-hmm. So this is the birth of the registrars and the transfer agents. And we have that exact same system today. We have very sophisticated registrars and sophisticated transfer agents, maybe not so sophisticated in certain places. We have shorter settlement. It's T2 now. It's going to be T+1 in a few months.
Next month.
Next month.
Next month. No one's ready for it.
Everybody's ready. But we're still living in this dematerialized, immobilized world, which is, almost all the problems. And so to David Webb's point, David Webb is very persuasively argues that you don't technically own any securities. You own a legal right. You have a share entitlement to somebody else's stuff held in somebody else's registry. And
this point, he actually, the case he brought up with Lehman, actually, I found fascinating. And I knew of this, but I hadn't really put it together. And he put it very succinctly. He said, because a lot of people would say, well, sure, fine. What's the problem with security entitlements? This is a great system. It's working so well, which, you go on to pick that argument apart, I think, very well. Right. But he was like, look at Lehman, where JP Morgan was both the custodian and the senior secured creditor.
Yes.
And so they just took the assets and your entitlements went poof.
Right. And that, just as a note there, years later, I was at a meeting with, not Lehman, I was at the meeting with Dick Fold, and he made that exact same argument. He said he knew what had happened, and he said that, and he was trying to argue for reform of the plumbing of the settlement system. He got it because he'd benefited from it for years, and he saw what happened to him when you're on the wrong side of the trade, and it's not pretty. Right. Just as a note, incidentally, you mentioned that the state case, and we don't have to talk about Overstock now, but I will say the Overstock case was interesting because it was a state case, and it was successful because it was in state court. And the attorneys who brought that case did so with a scalpel. They brought a scalpel, and they pled and they argued very carefully under California state security statute. And in a way, remember, you always want to avoid federal court. Federal court is where you take decades, nothing happens, and ultimately people will say supremacy clause, the SEC rules trump whatever the federal courts decide. So nothing ever happens. So the SEC writes rules poorly, they execute them poorly. Those become law in the federal courts, so you can never get justice. Yeah. So to find success, you have to go to state courts, and there's actually association, the National Association of State Securities
Administrators. Yeah.
Yes, NASA. And back in the day, NASA were some of the first people arguing for market reform, having great conferences. There was a guy named Peter Shepkavage, who was a retired securities lawyer, who's a great advocate in these areas. Peter taught me a lot over the years, and he was a NASA administrator. And it was the states that had these statutes that were, because it used to be there were all these exchanges all over the country that had their own rules, so the states govern those exchanges.
And interestingly, this Tennessee law, the other change it made was to eliminate the ability for brokers to put a choice of law provision into their customer agreements. And so if you're a Tennessee investor, you have to be governed by Tennessee law.
Isn't that interesting? Well, the beauty of the federalist system is that ultimately power returns to the states, and that has to be, and it's the part of the efficiency of our process. And the state regulators, state lawmakers have to, if things aren't going to happen at the federal level, then the states have to be the ones that come in and make it happen. And so it's good to see that that's.
Yeah, I was watching the hearing, and I really wasn't. I didn't think it was a big deal. And then after David Webb got up there, someone from SIFMA came up, and he's like, "Everything is great. Don't you dare change anything." And I'm like, "All right, wait a sec. There's something here now. If they send someone to Tennessee, there's something here."
Right. That's funny. SIFMA came. SIFMA's always there.
Always.
They're always there outside the room.
Someone
getting ready to comment.
told me that it's almost like they have a satellite office at the FTDs. All right, here's another question we got. What does utilization and cost to borrow tell us about rehypothecation and short interest? I know these are data sets you look at, as we've talked about before, in securities lending that we've got as well. And I thought that I mean, I know, cost to borrow is generally reflective of demand for lending. So there is maybe some information in there, but can it tell us anything? And especially, I actually think that's an interesting question. Can utilization provide any insight into rehypothecation?
Yeah. Such a good question. So first of all, I have to say something interesting. By the way, I teach. I wear a lot of hats in my teaching life, and I'm lucky as a lecturer, I get paid just to teach. I don't have to go to meetings or deal with politics, which academia is every bit as bad as you can imagine. Henry Kissinger's line, the fights are bitter because the stakes are so low, is absolutely right. And the politics can be soul crushing, but teaching is wonderful, and I love it. And
my brother-in-law is a scientist up here in Canada. He's interestingly, he's a lichenologist. And yeah, highly specialized, studies lichen, and for some unfortunate reason, he's had to be sort of in a management role for the last few years, and he hates it. And he's very close now to getting back into research. He's very excited. So I
know it. Also, the problem is that they passed the baton around for who gets to be king for a few days, and it's a person who's completely unqualified to be in that role.
Yeah.
They may be a great researcher, but they're not a good administrator. Yeah. Anyway, I say that because I've had the chance to integrate my consulting work with my teaching very carefully, and a lot of really cool things happen. One of the things I'm doing, I'm actually writing a research paper about it, is you can take an options chain and using put call parity and construct an implied borrow price. You can actually reconstruct the cost to borrow from an options chain. And you can actually build a visual surface of this. It's actually a very cool process. Just by looking at the options chain using put call parity. So I had to note that because it's a fun discovery that I'm working on my research days. And in general, the implied cost to borrow of the at the money spot contract generally tracks the cost to borrow in my data. Sometimes you get big deviations when there are weird liquidity events, but in general, they tend to be about the same. As we know, the utilization rate, the problem with the utilization rate is that is not, it's not a statistic I would rely upon in a hard way, because it's just too hard to know what the utilization rate is. And in truth, in hard to borrow securities, you just don't know what kind of things are happening around to help customers get short. The big firms get short.
Yeah, and you see it pegged at 100%. Constantly for some of these securities, right?
Yeah, exactly. I think that one of the open questions in the financial research, I'm actually looking at this in another paper, is to what extent borrow costs are predictive of price activity. And it's a hard thing to know, but because it's a collateralized loan, bigger hedge funds, more with multiple prime brokers, get a better rate, better cost to borrow. What's interesting about cost of borrows is that there's a huge, huge range with a huge standard deviation. Right. So there's not one price. And because of that, just that fact in the stock loan data that you and I both know, Dave, that one fact tells me that it's very hard to this is such an opaque market. The fact that people are basically selling the same product to different individuals at different prices tells you that this market is lumpy and discontinuous and not very efficient at how it prices things.
Oh yeah, I worked with a company years ago, and their entire product was basically helping hedge funds maximize ROA, your return on assets, by moving between primes depending on who is offering the best rebate,
Right.
The best interest rate.
And that's a great product. And by the way, we haven't talked about rebate. Is it worth discussing?
Sure.
Or your viewers familiar with that? So just so people are familiar with the mechanics, in a short sale is, again, a collateralized loan. But the way it works is you tell your broker you want to short XYZ securities. They borrow them. Hopefully they borrow them. The securities are sold. The cash proceeds of that sale are placed in an overnight account. And that overnight account, typically, this is the repo market. Typically, they're invested in treasuries. And if it's an easy to borrow stock, i.e. a positive rebate stock, that some portion of that overnight return is dividended back to the hedge fund. And that's a positive rebate. So your cost to borrow in that sense is whatever you would normally get from that cash in full, less what the broker holds back. If it's a hard to borrow stock, the broker might keep everything, keep the full overnight proceeds on the cash invested, or they might charge you a fee on top of that, i.e. a negative rebate. So in addition to keeping the collateral with your broker, you have to pay an extra fee. Right. It's an annualized fee. It's marked to market every day as some function of the value of those securities. So if the stock that you're short goes up in your margin account, you might have a margin call. You have to put more cash into that account, unfortunately. And I'm told that the way it works now is it's every 30 days. You don't pay every day. You pay every 30 days. Then in 30 days, you settle up the rebate total. If it's negative, you pay to your broker. If it's positive, they give you some amount back in 30 days.
So one thing we get a lot of questions about as well is how does what we keep talking about the mechanics of shorting in the market, in the equity market, but how does this work when you're dealing with swaps and derivatives? I mean, in theory, right? If I'm going to get some short exposure through a counterparty via a swap, that counterparty, in theory, is going to go actually short that and then swap that exposure with me. But that's not necessarily how it works, right?
Right. Well, I will this is an area where I'm not necessarily an expert, but I can tell you one interesting thing about the data, and I know you see this too with the data we look at stock lending. Most stock loans are collateralized by cash. That is the cash from the sale of the stock and the initial short sale ticket. So in the vast majority of stocks, the vast majority of scenarios, particularly in the US, there's the cash collateral. The cash collateral loans are most of the total stock lending on any given day. However, in some stocks, in some strange situations, in the stock loan data that we study, you see non-cash collateralized loans that can be quite large. I have to assume those represent swaps in some way, meaning something is happening there where the fund is perhaps keeping the cash, and instead, in lieu of that cash, they are posting other securities or other high quality collateral, or something else is happening that the broker keeps as their collateral for that loan when it's a non-cash collateral.
Okay, interesting. All right, let me ask you one last question on this whole topic, which I have gotten so many times. Do you think that tokenized securities, securities that are tokenized on a blockchain, can be used in any way, shape, or form as locates?
You mean in being compliance with current securities laws?
Yes.
Well, that certainly was the goal of this exchange called T0, which was started, and which I have no connection with and I don't know anything about, but I believe that was their goal.
To tokenize securities, yeah. That's right.
Yes, and also tokenized securities lending. That was, I think, was the goal of the process. People have tried to do this exact thing, and they've gotten a lot of input from a lot of fancy attorneys along the way about whether it's in compliance or it's not in compliance. I believe T0 had some approval. It was one of the first exchanges approved to do this.
They got there was some approval in sort of working with another exchange. NYSE ultimately, I think, bought T0, or at least bought a controlling chunk of it, and they never actually had sort of blockchain based anything, I think, other than they put market data on the blockchain. But I haven't kept up with it, so I don't know if in the last year or so anything has changed about that. I really haven't paid attention to T0.
It never really went anywhere, and unfortunately, which is maybe it was bought intentionally so that it wouldn't go anywhere. We just don't know. The sad thing, I should say, maybe the answer to this: blockchain, i.e., an encrypted database, is the ideal solution to a lot of these problems of fungibility and immobilization and dematerialization. When I was doing research, I was doing some research for this discussion. I actually went back to my old notes for my PhD dissertation. I had a chapter about the history of these institutions. And I actually found there was debate. There was a huge debate in Congress. So Reg National Market System was 1975.
Yep.
There was a lot of debate, and you can go read letters by the senators to each other. They talk about fails in their letters: fails to deliver, fails to receive. These are terms that actually come from the 70s. And centralized clearing and immobilization, dematerialization was not the only option. There were debates about having decentralized immobilization, about having multiple clearing entities. There were debates about alternative systems. So the one that we have today isn't the only one that was debated back in the day. But if David Webb's right, it was fated to be always.
I don't know. He seems to think the CIA is really competent, and from what I've read, they're just not. They're really not. But they're really good at marketing.
I absolutely think that's. I absolutely think that this is the debate about incompetent or evil. Is there government incompetent or is there government evil? And I see plenty of arguments on either side. I also think our government.
I read a great history of the CIA just recently, really in depth, and the theme was, man, are they bad at what they do, and man, are they good at not seeming that way.
Right. It's the government is fragmented. It's in silos. You find people in one silo that have no idea what's happening in the silo next to them. So who is, the whole point of reason we have a CIA was to centralize intelligence because it was so fragmented.
Yeah.
But then that was terrible after 9/11 revealed that was bad. So they created a DNI whose job was, again, to centralize the intelligence. And then, of course, they just stopped giving information to the DNI. So who knows who's in charge. Back to tokenization. It's a perfect solution.
Okay, a good solution. But here's what people tend to allege. They say FTX created all of these stock tokens, and they were trading on FTX. And they said at one point there was a one-to-one relationship between these tokens and actual shares of stock being held, but that wasn't, if it was ever the case, it certainly was not the case when it all came crashing down as a giant fraud. But because they created all these tokens, people say, well, they were being used as locates to short hard to borrow names. And I don't see how that's possible in our current framework, both from a legal perspective, but also from a collateral perspective. Even if I don't think finding locates is any problem. People don't even really need to find them when it comes down to it. But maybe I'm mistaken on this.
No, I think I'm with you, Dave. Honestly, I can't explain that. I will simply say that short selling is, to understand it, to our discussion of rehypothecation, it is all about collateral quality.
Right.
So if you look at the range of prices people pay to borrow stock, it's a function of the quality of your collateral and also the quality of you as a borrower. So the people who work in securities finance, they're obsessed with collateral quality. The other thing that to just realize is that a short sale is an overnight loan. So it's an overnight collateralized loan that is constantly being repriced. And many short sellers face not just repricing risk, but recall risk. Now, recalls aren't necessarily common, but they do happen. So they're just situations where the lender says, I want my stock back. Right. And you have to be prepared for that to happen as a short seller.
Right. Okay. Excellent. I think this was really informative and interesting. And I think it goes to your point where, I guess I don't remember if it was in the last episode or in conversations we've had, but you've told me that when you get in the room on a case with the lawyers from the other side, the answer is always rehypothecation.
Yeah, it's all rehypothecation. Actually, and the funniest thing was so back in the day, prior to the July 2008 emergency order, when the SEC banned naked short selling for all the primary dealers because things were so bad. Before then, there was such skepticism and derision of people who complained about naked short selling, and from not just Wall Street, but the financial press. There was a group called the Society of American Business Editors and Writers, SABU. And SABU had an entire conference.
I've spoken at one of their conferences.
Oh, you have? I didn't know if they're still around. That's good. Well, the SABU had entire conferences about the naked short selling conspiracy theories. And it was financial journalists putting down anybody who thought that there was legitimate concerns around market reform. And I was at one of those conferences, and there was a reporter from the New York Post. And I remember him saying to me in his thick Staten Island accent, it's all rehypothecation. It's all rehypothecation. You don't understand. It's all rehypothecation. It's just fine.
Right.
Which is his code for saying, there's not naked short selling and fails. The system is just structured so that chain lending happens, and there are all these honest reasons for why things happen. Okay, maybe. But if that were true, then you wouldn't have all these fails going along with it. Right.
Right. Exactly.
That's the response.
So that takes us to one of the, from a common stock perspective, at least, the leader in your threshold count data, which is Overstock.
Oh yeah.
So let's talk about that.
So the Overstock case is a fraught case. I'll be careful today. It was. So there were two big lawsuits Overstock filed. One was 2005, one was January of 2007, and it ultimately ended in 2014, you could call that. So it was a 7-8 year process, but in all, the litigation took about 10 years. I had known the CEO for 25 years. He was a teacher of mine when I was at Dartmouth. He actually led a foreign study program to China the summer of 1999. And that's how I met Patrick. And so I've known him 25 years. And he's a controversial figure, but this was a situation that demanded someone who really wasn't afraid, I think, to go against trend. And I went to work there in 2005. Actually, I had been in grad school. I got very, very sick, and I had to leave graduate school. I was in the hospital a long time. And I got out, and I had no idea what to do. And Patrick said, well, listen, we're involved in this market reform effort. We've learned that Overstock is on the threshold list. Come help figure out why that is. And so what began, really, I was a fly on the wall for this process, learning about what was going on. And in 2006, I spent a lot of 2006. I rented in those days, Reuters had a financial terminal like Bloomberg. And I remember sitting in my apartment in Salt Lake City, taking screenshots of these block trades, along with these options trades. We had no idea what they were, but we were taking pictures of it, trying to figure out what was going on. And later we figured out these were the conversions and the reversals that were the foundation of the abuse of the options market maker exception. And in fact, I remember meeting a guy who explained to me, okay, that's a conversion going on right there. A market maker is creating stock out of thin air for the purpose of helping a counterparty obtain hard to borrow securities. The Overstock case was filed in early 2007, and originally was against everybody that had a DTC account. They got some fails data, and so they understood that there was naked short selling happening. There were fails, and that data became the foundation for the lawsuit. But what was key about the lawsuit, as I said earlier, was pled very very well by this California law firm of Stein and Lubin. The lead attorneys were Ellen Serangle, Dory Griffinger, and Jonathan Summers. And these were not conspiracy theorists. These were serious adults, professionals, and they understood securities law very well. And they conducted this case beautifully. And they filed it under the California state statute. Involved something called conversion. And conversion is like a legal taking. So if you imagine naked short selling and fails to deliver as robbing somebody of their property right, at least this is my non-lawyer understanding of the conversion claim. Essentially, they had converted your property right. They had taken your property right from you in some way. So the Overstock case was pled very specifically under these California statute numbers. I think one was called 25-400, and there was another California security statute that was pled under. And ultimately, Overstock settled with almost everybody except for Goldman, and the case went all the way to the California Court of Appeals. You can read the Court of Appeals ruling from 2014. Ultimately, the court ruled that Goldman, the Overstock settled with almost all the plaintiffs, and the last one was Goldman, and the court ruled that there was not enough physical nexus for Goldman Sachs execution and clearing to be included in that.
California.
Because of California. So Overstock, so there was a jurisdictional issue, but the court nevertheless goes through the facts of the case very clearly. It talks about the individual market makers whom the SEC and FINRA had sanctioned, and how the brokers may or may not have been on the other side of these trades. The discovery, and I can't talk in detail about the case because there's a very serious protective order, as you can imagine, in all these lawsuits. What was interesting about
17 years later.
17 years later, I still can't tie. I live in fear, so I'm very careful only to discuss things in the public domain.
I'm the same way about a company I used to work for.
Right. There's a law. Yeah. Suddenly, these companies start working very well when 17 years later.
That's right.
There were, for those interested, you can read the California Court of Appeals ruling. You can also read on the Economist website, and we'll find a way to get this to you. There was in the case, so this case was covered by this very serious protective order, millions of pages of discovery, hundreds of hours of depositions on all sides. It was a tour through how settlement work, how options trading works, et cetera, et cetera. All this stuff, discovery, was covered by very serious protective orders, and all the filings in public were redacted to protect trade secrets. However, at one point, an attorney for the defense made a public filing that was unredacted, and a whole bunch of discovery went into the public domain that was unredacted. And they tried to claw that back. My memory is they tried to claw that back, but news organizations got involved. The Economist magazine got involved, and Rolling Stone got involved, and a very famous First Amendment attorney represented them. And that also went to the California Court of Appeals, and they prevailed. So there's a significant amount of discovery in that case that you can read. I think at least on the Economist website, they still have some of these documents up where you can read some of the discovery, and a lot of it's spicy, involving the compliance department and other things.
We'll provide the links if people are interested in the show notes.
Right. But it was, again, like I said, it was a successful. I regard it as being a successful effort because it was pled specific. It was very expensive. So the board had to provide the support, approve all of this. But Overstock was on the threshold list. Even today, Overstock is the #1 ticker on the NASDAQ threshold list. It was on for 922 days total, the most of any on the NASDAQ threshold list. And so there had to be some explanation for it. And I think a lot of us were just so frustrated that justice was so hard to obtain, and we had to spend so much company treasure had to be spent to get justice. And I think ultimately a measure of justice was obtained.
Was there ever any, I guess it would be hard to say if everything was settled, but I wonder in any of your work, was there ever any estimate in terms of the cost to the company, not from a a legal expense perspective, but from a market cap perspective, was
Yeah.
there ever any model built to try and estimate something like that?
There was, and all these lawsuits, there are damage models. I'm not sure I'm allowed to speak about that, but that was certainly part of the case. There were some interesting, very famous economists involved in that case who provided damage models on both sides, as you would expect in litigation. But yes, certainly part of the claim was damages, that the company was harmed, and the shareholder, there was a plaintiff suit, so there were California shareholders who were part of that lawsuit, and part of the allegation was that they were harmed and the company was harmed, particularly because there were 2 securities sales at that time. The whole point of our capital markets is that young, growing companies sip at capital markets.
Yeah, right.
And that's the whole point. It doesn't matter if it's Overstock or it's Netflix or if it's Cabela's or Chipotle or any of these companies, Lazy Boy that were on forever. Taser was a big one. Taser International is still around, but they changed their name, I think, to Axon or something. But they were on the threshold list forever. Taser was on the threshold list forever. And these are companies that were shocking, right? Taser was on for 562 days. These are companies trying to develop ideas. They're figuring things out. They're not perfect. They make mistakes. They get some things right, they get some things wrong. And so the whole point is that they go to market expecting a fair price and expecting to be able to do secondary offerings and raise capital in a fair way. And that was not happening during the early days of Threshold List.
And what about, we got this one question about and I think you wrote something about this in your presentation about the NSS and FTDs and how that affects proxy voting.
Well, I mean, this is, if you throw out everything else we've talked about, Dave, if you set aside everything else, you're just going to say, the hell with it all. They're crappy companies. Who cares? If nothing else, you should care deeply at how this system messes up with the proxy voting system.
Yes, I totally agree.
We talked about Dole Foods last time. The Delaware Chancery Court was the judge's exasperation in the Dole Foods case is visible. So you had there was a plaintiff's lawsuit. 36.8 million people showed up. I'm sorry, 36.8 million shares were in the class, but almost 49 million people showed up. That's almost 20% extra. So to your question of how much could rehypothecation, how much can chain lending happening, there's your answer.
Was that reflected in the short interest numbers for Dole?
I believe it was. I actually haven't looked. I should go back and look at that, and I haven't checked on that recently. I need to go look on that. I don't know the answer to that question.
Yeah, that would be interesting.
It was. What I don't know is whether the loser in that case paid extra to make it go away. That I have to check on, is if the loser who was paying that had to pay extra, or whether they just proportionally pro rata allocated the payout per share. I need to check on that as well. The judge ultimately did what they could, and I think they gave a pro rata interest to the 49 million people who showed up of the 38 million.
That weird? Like, shouldn't it have been the short seller's obligation to do that?
You would think there would be some kind of payment in lieu obligation,
right?
I would regard, but I think maybe that's why it was a novel area of securities law, because nobody ever thought about whose problem it is if there's a settlement, and short sellers have created additional beneficial owners.
That's crazy. Yeah. All right, let's go back because in the Overstock case, this figure came out that I've seen around a lot, and I'm curious about what is this true? And if so, how could this even be true? But the figure is that Goldman, that 75% of their income as a firm was from securities lending. Is that even accurate? I've seen this number thrown around all over the place.
Dave, I'm not sure I'm able to talk about that. I want to talk about that, but I'm not sure I can. I want to be really careful. I have no assets, so I
don't want you to get anywhere near, a line that you can't cross.
Let me respond. I'm going to be a politician, and I'm going to answer the question I hope you ask me. So If you go to the Economist website, which we'll provide a link to, and you see the discovery documents that were released, that question may be answered in there. Okay. And in addition to that, it may be there was a 5th amended complaint that Overstock filed with the court, but that was never allowed to proceed. So what happens is you get in litigation, you learn things, and you amend your filing. You amend your complaint to reflect your new information. There were 4 amendments, or I should say there were 3 amendments to the 4th version of the complaint, and then there was a 5th amended complaint, which the company had which alleged in great detail a lot of interesting facts, and that is in the public domain, this 5th amended complaint. I know because I found it on the Economist website and was part of this release. And people can read this 5th amended complaint, and it is a very interesting set of allegations, I should say. Things not proven, things that were alleged that the company hoped to discuss in greater detail. If you go, by the way, just as a note, if you go to any, just generally speaking, if you go look at, years ago I put this together, outside of the lawsuit, just looking at data from annual filings of brokerage firms, use the prime brokerage portion of many banks is hugely profitable, and it's a major source of the revenue. And you can just see that from their 10K filings for the firms that are public. And that was certainly true of companies like Goldman and Morgan and others after they went public. You can break that down in their annual filings, and you'll see that the prime brokerage division is a big part of their bottom line.
Okay, so super interesting so far. Another question we saw thematically across every platform was how do we fix this? And I, we talked a bit about that last time. Maybe let's, but I think it's a question worth reiterating, or ideas worth reiterating. It seems to me, and let me tell you something, coming from now being up here in Canada, where you don't even have a reg show, let alone a reg show riddled with loopholes. It's even worse. And it's a huge problem both for Canadian markets, where there is abusive and naked short selling and market manipulation. But that's something that bleeds over to US markets from Canadian markets. We see it also bleed over into US markets from European markets, where you have somewhat, Europe has some really excellent regulation, but then there are some individual countries that have far less. And all of this is being harmonized over in Europe, but it's not there yet. And so things can sort of just pop up in Germany, for example, and start trading and shorting and borrowing over there. And that impacts the US as well. So to me, I think we need important changes in the US and reforms to Reg Show, including, I would argue, getting rid of the market maker exemption entirely, the Bernie Madoff rule entirely from Reg Show.
Right.
But imposing, as I think we talked about before, a settlement discipline regime in which you have mandatory buy-ins and escalating charges for failures. That seems to me step one. But step two is, it seems like you need a global solution, right? Otherwise, you're going to play whack-a-mole with this problem. And that seems just difficult to envision how we can get there.
First of all, Dave, I couldn't agree with you more. As we said, I think it's worth repeating some things we said last time that were really good. Yeah. One is, when the Treasury market had fails, they fixed it overnight by simply imposing fines. So the fails went away. So fines work.
Yeah.
Right. And every market has a clearing price, right? There's some a level of fine you can assess, at which point fails go away. So the fact that we don't do that should tell you that the system is deeply rotten and corrupt, because that's such an easy solution. You could even say, hey, fine, keep all the dematerialization, immobilization, rehypothecation you want, just fine for failing. Yeah. That's the easiest solution. That's the most elegant solution. And it was in the original draft of Reg Show, and it was taken out. Peter Shepkavage, the NASA administrator mentioned, who taught me all this, who was an expert on how Reg Show was made, talks about that as being the great disappointment of his professional career, is seeing fines taken out of Reg Show, because you could have avoided so much hassle on down the road. The problem with centralization and unifying regimes is, if you build it badly, you're simply replicating corruption, and you're simply, I think, well, let me talk about that in context. I had huge hope for blockchain settlement. I had huge hope that we had this new set of institutions come along. They were going to have immutability. They were going to have this giant ledger that people could share. They don't have to trust each other to trade on this ledger, and that somehow this would be fixed. What happened was nothing. And in some situations, worse than nothing. You may recall Blythe Masters from JP Morgan. She left JP Morgan. Yeah. She went to Australia, to the ASX, to build a blockchain settlement regime.
And that was R3, I think, right? And
exactly.
And then they ended up abandoning blockchain.
They abandoned it, and they wrote it off. The 200 million that they spent, almost, they wrote it off, and the CEO had to make of the ASX made public apologies, saying, "I'm so sorry that happened. We'll never try that again." Almost, it was if it was set up to fail. So I know of this. Sadly, this was the moment. This was our chance to bring attention to this matter. And with this new tech, this shiny new toy, you know, a solution in search of problems. Well, here's a problem. And again, I said last time, yes, you have the fat finger problem, the immutability problem. All of those things are things that could be fixed. But candidly, unless you change, there are so many people who benefit from the current system existing as it is. I mean, entire institutions, the whole share registrar system, the whole transfer agent system could all be replaced with a computer. It could be replaced with my computer that I'm on right now. All that could be done off of my computer. And so they act like they're the high priests of this holy temple, and without them, you know, the world would cease to exist. But the truth is, the whole system is built on 1970s technology. It will not be changed. I'm more pessimistic now than I was before, because you would need tremendous motivation. It would require an amendment to the Securities Act. I think you'd have to do a new round of amendments. And that happened in the 80s, it happened in the 90s, but I think you need a new round of amendments to really change. And at this point, DTCC is arguably one of the most powerful organizations in the entire US financial system. DTCC prides themselves on clearing over $2 quadrillion worth of trades every year. And they used to be in Lower Manhattan. Now they're in New Jersey after Katrina, because some of the stock certificates got wet, so they moved over there. And last I checked, it was probably more heavily guarded than Fort Knox. And this is a building that just they're owned. DTCC is owned by, of course, all the big broker dealers. Right. And this, any time that you try to reform this system, they go to policymakers and they say, it's like firemen when you try to cut the budget in the local city budget. Maybe you don't need that extra fire truck. Well, they say, well, babies will die. Well, anytime you try to reform the stock settlement system, they talk about lack of liquidity. They talk about lack of trust in the system, capital flight. So it's very, very hard to build a constituency to oppose those who benefit from the system and who are entrenched in the system.
Yeah. All right, so we're going to leave this even more cynical than when we came in, but we're going to keep trying. No, but I mean, there's nothing more important than understanding the current system, understanding who benefits from it, understanding their arguments, and you're never going to be able to change it until you do.
Let me actually end with a blue pill. So we should end on a blue pill. Okay. I think that's important. Maybe not a blue pill, maybe a white pill. That's the way to go. The white pill is retail options trading has made a whole bunch of people aware of this system that weren't aware of it before. You know, when Robinhood said to their GameStop people, you can't trade GameStop. Yeah. Suddenly people understood, wait a minute, what's wrong with this system?
Yeah. How can you take away this buy button? How is that even possible?
So there's a whole generation of people understanding the bizarreness of this world who understand gaslighting is bad, and who saw the CEO of Robinhood on TV talking about DTCC because he has essentially a kind of a credit extended him by the clearinghouse. And the clearinghouse was saying to him, these things are happening and we're going to have to put an end to it. So that's the white pill, is people are talking about it. We're having these conversations. We're bringing awareness. The next step is somehow, there needs to be organization. Organization helps. Charismatic leaders help, like yourself, Dave, like you, Pink. Charismatic leaders bringing attention to these important topics. And because it isn't in any of the books behind me. Yeah. None of the stuff that we're talking about is in any of these books. It's like we have this oral history, like we're Aborigines walking through the outback with this oral history of where the watering holes are. And so we're all trying to, I'm telling you guys, you're telling others, this is where the watering holes are. We have to keep the oral history going. We have to write it down. And hopefully maybe somebody writes a book about it.
Let's hope. I think this has been great, John. Thank you so much.
Thank you for having me.
And I don't know, how can there not be a part 3? Because it just seems like there's always so much to talk about.
Absolutely. Yeah. My pleasure.
All right. Well,
thank you so much, John.
Yeah.
Make sure you guys like and subscribe, share this video with anyone who might be interested, which I have a feeling most of you are. So this was a great conversation. We appreciate the greater Irvine community for providing these questions for us, and we look forward to the next conversation. So go ahead and drop your questions for the next time down in the comments, and we'll be sure to include it the next time we welcome John on. So thank you again, John, for joining us. Thanks, Dave, and we will see you guys next time. Take care.
Thanks, everyone,
thanks a lot.
For listening.